As of 12:51 p.m. Eastern Time on this Friday, October 31st, 2025, BigBear.ai Holdings, trading under the ticker BBAI, is priced at $6.89 per share. That represents an intraday gain of about 1.77% or 12 cents on the day. But that simple green number hides the real story. The stock has been in an absolute battleground today, trading in a wide range between $6.55 on the low end and $6.96 on the high end, all on significant volume of over 90 million shares. This isn't calm buying. This is a high-volume tug-of-war, and it perfectly captures the tensions surrounding this company. The immediate expectation when you see a stock associated with artificial intelligence and national security is that it's on a one-way trip up. The narrative is powerful. BBAI is a key player in providing AI-driven decision intelligence, and it's landing major government and commercial contracts. The reality is that this stock is one of the most contentious and volatile names on the market, caught between a compelling growth story and a deeply troubling financial picture. Most investors are looking at the headlines, and the headlines have been good. Just last week, on October 23rd, the company announced the deployment of its Veriscan biometric identity platform at Chicago O'Hare International Airport, one of the world's busiest travel hubs. This is a big, visible win, supporting U.S. Customs and Border Protection. Before that, on October 13th, BBAI announced a partnership with T-Second to deliver AI-enabled infrastructure for battlefield applications. These announcements sound exactly like what investors want to see from a company positioning itself as a critical partner for defense, intelligence, and homeland security. The expectation is that these contracts are the start of a massive wave of adoption, turning BBAI into a smaller, faster-moving version of Palantir. This narrative has been effective, helping the stock climb over 300% in the past year. But if the news is so good, why is the stock fighting tooth and nail to hold the high $6 mark instead of challenging its 52-week high of $10.36? The reality, the part of the story that the bullish headlines obscure, is found in the company's financial statements. The market is currently grappling with the fact that while BBAI is landing contracts, it is currently not profitable. In fact, it's losing a significant amount of ground. Recent reports show revenue has actually been declining over the last few quarters, and the company's net profit margin is deep in negative territory. This is the central conflict. Investors are being asked to pay a premium for a growth story, but the numbers are, for now, showing contraction. This is why the upcoming earnings report on November 10th is so critical. The market is desperate for a sign that this trend is reversing, that the new contracts are not just press releases, but are translating into actual sustainable and profitable revenue streams. The expectation is a turnaround. The fear is a continuation of the same losses, which analysts are already projecting at another loss of around 7 cents per share. This brings us to the other major force at play, the short sellers. This is not a stock that is being ignored by those who bet on a decline. As of the most recent data, BigBear.ai has a very high short interest of approximately 17.7% of its float. That translates to over 76 million shares being held short. This is a significant bet being made by a large portion of the market that the stock price is unjustified and will fall. Their thesis is straightforward. This is a company running on AI hype, fueled by retail enthusiasm that does not have the financial foundation to support its current market cap. They look at the negative earnings per share, the shrinking revenue, and the cash burn, and they see a valuation that is disconnected from fundamentals. You can find this data yourself on platforms like Fintel or Finviz, which aggregate the official reports from the exchanges. It is essential for any investor in a stock this volatile to understand the metrics of the opposition. Now, many investors, particularly on social media forums, see a high short interest number like 17.7% and immediately expect a short squeeze. This is a classic expectation. However, the reality of BBAI's trading dynamics makes this scenario very difficult. A squeeze requires shorts to be trapped, unable to buy back shares to close their position. The key metric to watch here is the days to cover or short ratio. Because BBAI has such enormous trading volume, regularly exceeding 90 million or even 100 million shares a day, the days to cover is incredibly low. often sitting at less than 1 day. This means that, in theory, every single short seller could close their position in a single trading session given the available liquidity. They are not trapped. Furthermore, the cost to bet against the stock, known as the borrow fee rate, is very low, hovering around 0.70%. This isn't a stock that is difficult or expensive to short. It signifies that large institutions have plenty of shares available to lend out, and there isn't a frantic scramble to find shares to short. What's your take on the 17.7% short interest? Is it a smart bet against the company's fundamentals, or is it just market makers hedging against this volatility? What is worth monitoring, for those looking for irregularities, is the off-exchange short volume and the FTD, or fails to deliver, data. Off-exchange volume, often through dark pools, has been high for BBAI, recently accounting for over 41% of daily activity. This can sometimes be used to manage large orders without impacting the public market price, but it also reduces transparency. More importantly, the FTD data from late September showed some significant spikes, with hundreds of thousands, and in one case over 1,800,000 shares failing to be delivered on their settlement date. This can happen for clerical reasons, but persistent FTDs can sometimes suggest naked short selling or other settlement system stresses. This is the kind of deeper information serious traders watch, as it points to friction in the market mechanics beneath the surface. This entire battle is being fought in public, especially on platforms like X and Reddit. You can see the expectation versus reality dynamic in real time. For every bull posting about the O'Hare contract and saying, "Just hold, this will be $10 very soon," there is a bear pointing to the chart and the fundamentals. Comment threads are filled with arguments about dilution, with some users highlighting the massive volume as a sign that institutions are unloading shares onto enthusiastic retail buyers, calling it dilution for the delusional bulls. Others see the failure to break and hold $9 as a major technical rejection, suggesting the momentum has stalled. This is exactly what we are seeing in today's price action. The bulls who bought the dip at 655 and the bears who sold the rip at 696 are in a dead heat, waiting for the next catalyst. For those maybe less familiar with the company itself, BigBear.ai provides predictive analytics and artificial intelligence platforms. Their primary customers are in the U.S. defense, intelligence, and homeland security sectors. They are in essence in the business of making sense of massive, complex datasets to help government agencies and commercial clients make better and faster decisions. Their work includes things like logistics planning, supply chain management, and, as seen with the O'Hare contract, biometric identity verification. This puts them in direct competition with some of the biggest and most established names in the field, from giants like Palantir to other AI-focused firms like C.ai. The institutional ownership reflects this high-stakes environment. While the top holders are passive index funds like Vanguard and BlackRock, you also see a heavy presence from high-frequency trading and quantitative firms like Citadel, Renaissance Technologies, and Susquehanna. This signals that BBAI is a favorite trading vehicle for sophisticated players betting on its volatility. Looking forward, the entire thesis for BBAI hangs in the balance. The bull case, the great expectation, is that the company is at an inflection point. They believe the recent contract wins are just the beginning, and that the company will successfully transition from a smaller project-based firm to a major platform provider with recurring high-margin revenue. If they can show even a small sign of this on the November 10th earnings call, a beat on revenue, improved guidance, or a clearer path to profitability, the high short interest could be forced to cover, adding fuel to a rally. The bear case, the harsh reality, is that the company is failing to execute. They see a business that is struggling with growth, burning cash, and competing against giants, all while the market has awarded it a hype-driven valuation. If the earnings report confirms these fears, the technical support in the $6 range could easily break, validating the short thesis. This is not a stock for the faint of heart. It is the definition of a show-me story. The company has presented a compelling narrative of its technological importance. Now the market is sitting with its arms crossed, demanding to be shown the results. Comment below if you think the upcoming November 10th earnings call will finally show a move towards profitability, or if it will be another disappointment. The action today tells us the market is completely undecided, and the side that wins this tug-of-war will likely see a very aggressive move in their favor.